नमस्कार दोस्तों, वेलकम अगेन। मैं सचिन फ्रॉम फील गुड वेल्थ क्लब। हम कस्टमाइज तरीके से, कस्टमाइज वे से वेल्थ मैनेजमेंट सर्विसेज दे रहे गए 20 साल के अनुभव से। और ऐसे ही हमारे जैसा काम करना चाहने वाले लोगों को भी उनकी जर्नी काफ़ी इजी रहे, इसलिए अलग अलग वीडियोस के माध्यम से बहुत सारी इंफॉर्मेशन आपके सामने लेके आते हैं। उसका ही एक पार्ट है NISM 21A की एग्जाम देने वाले लोगों को थोड़ी सुविधा हो जाए है। जो भी रेफरेंस मटेरियल NISM का रहता है उसका चैप्टर नंबर 10 हम कवर करने वाले हैं। ये स्क्रॉल करेंगे, साथ ही साथ रीड भी करेंगे, और आप रीड कर पाएंगे और साथ साथ आप लिसन भी कर पाएंगे, क्योंकि मैं ये आपके लिए रीड करने वाला हूँ। तो दोस्तों, लेट अस स्टार्ट दिस चैप्टर नंबर 10। The chapter number 10, name of the chapter or the subject of the chapter is Performance Measurement and Evaluation of the Portfolio Manager. After reading this chapter, reader should understand the different ways of calculating the return, understand the different ways of calculating the risk, understand the different ways of calculating the risk adjusted return, the importance of benchmarking and peer group analysis, performance reporting to the investor by PMS and Global Investment Performance Standard, that is GIPS. The point 10 number 1, parameters to define the performance, risk and return. The main issue in performance measurement and evaluation is the human tendency to focus on the return the investment has earned over a period of time, with little regards to the risk involved in achieving that return. Proper performance measurement should involve negotiation of both return and risk of the investment. Now, the rate of return measures. The most vital characteristic of measuring the performance of the portfolio is to rate the return. Rate of return has many possible definitions. However, there is one possible definition for each purpose. So, one should make effort to obtain the clarity about the purpose for which the performance is to be measured, and then look at the appropriate return measure. And now the first is the point number 10.2.1, that is holding period return. The most straightforward rate of return is a holding period return. In short form, it is called HPR, popularly known as a total return or point to point return. It equals the income generated by the investment plus the change in the value of the investment during the period of investment is held over the beginning value of the investment, expressed as a percentage per annum. Percentage per annum. For example, if the market value of the investor's portfolio on 1 April 2018 is 1 lakh, and on 31st March 2019 the market value of the same portfolio stands out to be 1,20,000, the investor would have achieved holding period return equal to 20% in general. We can use the equation, the compute the holding period return. HPR is equal to end value minus beginning value divided by beginning value. Okay. Now, further assume that during the same period of the investment, investor has received rupees 5,000 by way of dividend and interest income. Then, what will be the formula? The HPR, holding period return, is equal to income plus end value minus beginning value, the total of these divided by the beginning value. That is called the equation 2 for calculating holding period return. The measure assumes that all income distributions are made at the end of the year. In spite of this limitation, total return measures is widely used and generally accepted indicator of performance. This is considered as the starting point of performance measurement exercise. Time weighted rate of return, TWRR, return versus money weighted rate of return. Let us now consider the rate of return over the multiple holding period. Suppose a portfolio has generated the following annual holding period return from 2015 to 2019. In year 2015, minus 5% return. In 16, minus 15.2% return. 17, 8.10% return. 2018, plus 30.75 return. In 19, 17.65 return. Suppose further that the investor has invested rupees 75,000 in this portfolio by making the contribution at the beginning of the year as follows. Then 2015 it would be 5,000. 2016 it would be 10,000, 15,000, 20,000 and 25,000. At the end of 2019, the investment would have grown to the value of 1,05,920.31 as shown below. Here, the 5,000, the investment made at the beginning of the year is 5,000. Return are minus 5. So return made during this period is absolute value is 250 minus portfolio value at the beginning of the period is 5,000. At the end is 4,750. For the next year, the beginning value would be 10,000 plus 4,750, that is 14,750, but the loss was made on 10,000, so it would be 2242. This summing up these two things, it will come to 12,508. In 2017, the beginning value will become 2,758 because 12,508 plus 15,000 is equal to 77,508. But the invested value was 15,000 and return was 8.1. The return generated during this time is 228.15. So the portfolio value at the end of the period would be 29736.16. Now in 2018, the 20,000 is added. So the beginning value will become 29736.15 plus 20,000, that is 49736.15. The return on 20,000 is 30.75. So return is the absolute term is 15,293.87. This is to be added to consider or calculate the year end end of the period value of the portfolio. It will become 65,030 rupees 0.01. Now this is to be added in the new addition at the beginning of the next year, that is 65,000 30.01 plus 25,000, it will become 90,000 30.01. It is the end, it is the beginning at the beginning of the new year, and return is 17.65. The absolute return generated is 15,890.3. Summing it up, the portfolio value at the end of the is 1,05,920.31. What is the rate of return generated during the period of 5 years? By discounting the terminal value of the investment, that is 105,920, to the cash flow contribution made, internal rate of return for the same can be calculated. Internal rate of return would come, as per the formula, it will come to 15.15. IRR is also referred as MWRR. This is very important. IRR is MWRR, money weighted rate of return. Financial calculators and the spreadsheet have inbuilt function of solving the IRR. MWRR is the annual rate of return at which the cumulative contributions grow over the measurement of period. MWRR depends on the timing of the cash flow. If we reserve the order of contribution of the same amount, that is 75,000 as shown in table 10.4, MWRR would change to 10.21. The reverse the order of contribution, then there will be difference. So which is cumulative contribution grow over the measurement period is annual rate of return at which the cumulative contribution grows over the measurement period. So cumulative contribution measure करने के कारण फ्लो बहुत इंपॉर्टेंट रोल रहता है. Now the flow is reversed, then the IRR or NWRR has become different, that is 10.21 by this formula. Alternatively, in order to calculate the underlying investment performance without being influenced by the timing of the cash flow, TWRR can be calculated. Global Investment Performance Standard GIPS glossary defines for time weighted rate of return as a calculation that computes period by period returns on an investment and removes the effect of external cash flow, which are generally client driven and best reflects the portfolio manager's ability to manage the asset according to the specified strategy of the objective. TWRR is the compound rate of growth over the stated period. In TWRR, portfolio will be valued every time there is an external cash flow. Every time then there is external cash flow. If there is no external cash flow, TWRR is equivalent to HPR. When there is an external cash flow, TWRR requires computing a set of return for each period. This period returns will be linked together to compute the TWRR for the evaluation period. Table 10.5 gives the contribution made by the investor along with the portfolio value of the 5 years period. A 2015, 2016, 2017, 2018, 2019. Investment at the beginning of the year is also mentioned. Portfolio value at the end of the period is also mentioned. In this example, there are 5 sub-periods. First step is towards calculating the TWRR is to calculate each period return as shown in table 10.6 using the equation E minus B divided by B. Now let us for each year, the returns are calculated. The next step is to link these 5 sub-period returns together. For chain linking these sub-period returns, we have to calculate wealth relative. Wealth relative is the ending value of 1 unit of money. Hence, what need is to be done to create a wealth relative is to add 1 to each period return as shown in table. Cumulative. The next step is to create a cumulative. You can see the return was 0.05. Add 1. इसका सिंपल समझना है तो 1 रुपया मैंने इन्वेस्ट किया, उसके बाद में उसका रिटर्न कैलकुलेट करने के बाद रिटर्न के हिसाब से रिटर्न कितना आया वो कैलकुलेट करने के बाद उसमें से मुझे उस जो रिटर्न को उसमें ऐड करना पड़ेगा, वो निगेटिव है पॉजिटिव है छोड़ दो, मगर उसको ऐड करना पड़ेगा। तो ये ऐड करने से एग्जैक्टली वो 1 रुपये का क्या हुआ ये बताएगा, तो उसको कहते हैं वेल्थ रिलेटिव। तो हर साल का हमने वेल्थ रिलेटिव यहाँ पे कैलकुलेट कर लिया। द नेक्स्ट स्टेप इज टू क्रिएट द क्यूमुलेटिव वेल्थ रिलेटिव फॉर द एंटायर इवैल्यूएशन पीरियड बाय मल्टीप्लाइंग ईच पीरियड वेल्थ रिलेटिव एज शोन बिलो। द क्यूमुलेटिव वेल्थ रिलेटिव में वेल्थ रिलेटिव को मल्टीप्लाई कर देना है हर पीरियड के लिए। क्यूमुलेटिव वेल्थ रिलेटिव टेल्स अस what 1 rupee has grown over a period of time. In this case, 5-year-old. In this example, 1 rupee has become 1.3396 in the period of 5 years. The compounded annual return can be calculated as TWRR is equal to 1.3396 power 1 by n and then minus 1. That is called a TWRR. The TWRR is same as geometric return. Note that unless the sub-period consists exactly 1 year, time-weighted rate of return will not be expressed as an annual rate, and we have to analyze the return. SEBI Portfolio Manager Regulation 2020 prescribes discretionary portfolio managers to disclose the performance using the time-weighted rate of return for immediately understanding processing immediately preceding 3 years. For illustration, see box 8.2. Now, calculate the time-weighted rate of return. Being with the market value at the beginning of the period. Being with the market value at the beginning of the period. Move through the time towards the end of the period. Compute the market value of the portfolio immediately before the contribution of withdrawal from the portfolio. Calculate the sub-period return for the period between the valuation date, that is date corresponding to the contribution or withdrawal date using the formula. Then repeat the step 3 and 4 for each sub period before at each contribution and withdrawal. Then there are no more contributions and withdrawals. Calculate the sub period return for the last period to the end of the period market value. Compound the last period to the end of the period market value. Compound the sub period returns by taking the product of 1 plus sub minus 1 plus sub period return. This is called geometric linking of chain linking, geometric linking or chain linking of the sub period return. Subtract one of the product value at arrived at the step 7. Express the result per 8 above in percentage terms to get the TWRR for the time period. Example, an account is funded 1 June 19 by amount 50 lakh. 1 March 19, client contribute additional 20,000, 20 lakh. The market value of the 28th February is 49 lakh. 1 October 2019, the client withdraw an amount of 10 lakh from the account. The market value at the account on 30 September was 75 lakh. The market value of the account on 31st December 19 was 70 lakh. Now 49 minus 50, you can calculate that return is 2. The cumulative wealth factor, wealth. Here is the calculations. Cumulative wealth. Okay. Now coming to the arithmetic mean return versus geometric mean return. Purpose of there is two portfolio choices available to invest in 1 lakh. First choice is to produce a holding period rate period of 50% and first year and 100% in the second year. The average return would be 25. In case of the first thing, in the end of the second year, the investor will end up with the 1 lakh only. The value of the portfolio is the same as it was 2 years ago, though the average annual return of the portfolio is 25%. With the second choice, the value of the portfolio at the end of the second year is 1,21,000 and the average annual 10% gain in value. Clearly, investor is better off with the second scheme, although produces average annual return lower than the first case. To understand how the outcome of the two cases are so different, it is important to distinguish between two methods of calculating return. The average annual arithmetic return is the simple average of the individual total yearly return. The yearly return is the sum of the percentage gain or loss in value of your portfolio due to change in asset prices. Any dividend and other cash distribution expressed as a percent of invested asset. Arithmetic mean is the simple average of the series of returns calculated by summing all the returns in the series and dividing it by the number of value. On the first choice, AMR is 25%. On the second choice, the arithmetic measure mean return is 10%. The best arithmetic of future years return based on the random distribution of the prior years. The best estimation of the future year's return based on the random distribution of the prior year returns is the arithmetic average. Statistically, it is our best guess for the holding period return in a given year. If we wish to estimate the expected return over a multi-year horizon conditions on the past experience, we may use the arithmetic averages. Second method of calculating the returns is the average annual geometric or compound return. Geometric or compound return. The average geometric return is far more important than average arithmetic return if one is analyzing the long run return or asset. The average annual geometric return is the rate at which the sum you invested at beginning of the period will accumulate to a given sum of the end of the period by process of compounding or continuously reinvesting over your dividends and a capital gain. A characteristic of compound returns is that it depends only on the initial and final value of the portfolio, not on the path by which that value has realized. GMR is based on a exponential function which represent periodic compounding. As shown in the figure formula, the process of calculating GMR is the same as TWRR. We are required to calculate the wealth relative for each HPR. Then we have to link these sub-period returns. In the above example, the evaluation period is 2 years. Hence, to calculate annualized return, the cumulative wealth ratio is portfolio of to 1 by 2 and being a number of years. For the first choice, GMR is equal to 0, and the second choice, the GMR is equal to 10%. For 1 year holding period, the arithmetic and geometric returns are identical since both they calculate the total return over 1 year. But over longer holding period, the geometric average returns always less than the arithmetic return expected when all the individual yearly returns are exactly the same, in which case geometric return equals to the arithmetic return. Given the initial and final value of the portfolio, a fund manager can always increase the average annual return by increasing risk. As noted above, the manager who takes your portfolio from rupees 100 to 50 and back to 100 again achieves an average arithmetic return of 25%. Yet every investor should prefer second manager to the first. Geometric return is the only way to compare long-term accumulation. It explains that what has really happened to the investment. If, however, we wish to estimate the probability of distribution of terminal wealth, would use geometric averages. Gross versus net return. The gross return is the total return generated on investment before reduction of any fees, expenses, and commission. Gross return is stated for a specific period of time. Net return is calculated after adjusting the gross return for fees, expenses of commissions, etc. Net return is the return investor actually makes. Hence, focusing on gross return can be misleading, though it can be used to evaluate and perform the investment at the broader level. Let us look at the following example of the portfolio, understand the difference between the gross return and the net return. Given below in the information about the size of the portfolio, investment period, fees, expenses, etc. Size of the same sample portfolio is 100 lakh, investment period 1 year, profit made during the year is 20% on the capital contribution, hurdle rate is 10%, other expenses such as brokerage, DP, charges, etc. Charge on a gross value portfolio is 0.5, upfront fee nil, setup fee nil, fixed management fee charge on average of capital contribution and gross value portfolio. Performance fee, example 20% of profit over the hurdle rate without catch up. The frequency of calculating all fees is annual. Now, the capital contribution made in the beginning of the investment is 1 crore. Upfront fees 0, asset under management is 1 crore, add less profit loss on investment during the year, the AUM at 20%, it will become 20 lakhs profit. Gross value of the portfolio at the end of the investment period is 1 crore 20 lakh. Less other expenses, 0.5 of the gross value of the portfolio at the end of the investment period, then gross value of the portfolio less other expenses. Fixed management fees, that is 1.5% of the fixed management fees 1.5% is to be reduced. Then portfolio, after charging the fixed management fees, it is reduced to 1 crore 17 lakh 75,000. Required portfolio value hurdle rate at 10%, which is to be calculated, and it has become 1 crore 10 lakh 1 crore 10 lakh. Then less performance fee, that is 20% of the profits over hurdle level, that is the amount is calculated over here. It is coming to 1,55,000. Portfolio value after charging the performance management fees, it has reduced to 1 crore 16 lakh 20,000. Less exit load 2%, 2 lakh 32,000. Portfolio value after charging the exit load 1 crore 13 lakh 87,600. Total charges A plus B plus C plus D 6 lakhs 12,000. Net value at the end of the net value of the portfolio 1 crore 13 lakh 87,600. Gross return is the total rate return on. For above example, it is calculated as follows. Gross return is equal to gross value of the portfolio minus capital contribution divided by capital contribution. Gross return is equal to now the gross value of the portfolio is 1 crore 20 lakh minus 1 crore divided by 1 crore. This would be the answer, and it is coming to 20%. Net return is the return earned after adjusting all the fees, expenses, and it is calculated as follows. Net return is net value of the portfolio minus capital contribution minus divided by capital contribution. Net return is equal to, in this case, 13.88. Pre-tax versus post-tax return. The pre-tax rate returns are returns before the taxes, and post-tax returns are the returns after the taxes are paid on investment income and realized capital gain. Investor belong to the different tax bracket. Hence, the performance of the investment is communicated as pre-tax rate of return. Investors or their financial advisor are expected to calculate the post-tax return by adjusting the pre-tax return to the tax rates applicable to the investor. The tax return is equal to post-tax return divided by 1 minus tax rate. Pre-tax return, we have understood. Post-tax return is nothing but pre minus tax, pre-tax into return into 1 by 1 minus tax rate. Pre-tax return enables comparison across different investment and strategies, since the different investor may be subject to different level of taxation. However, what really matters to me, the investor, is post-tax return. Hence, they make investment decisions on the basis of the post-tax performance. An example of post-tax return calculation is given below. Post-tax return we have seen. Now compound the annual growth rate. CAGR, compounded annual growth rate. Compounded annual growth rate is a measure of an investment annual growth rate over time. With compounding, it assumes that the any dividend income rate declared by the investment is reinvested to the same investment on the days of market price. Hence, here the compound interest formula to determine the CAGR between the opening and the closing wealth. The formula is A divided by P power 1 by T minus 1. A is a closing leg, P is a opening wealth. T is the time period in the year. Suppose an investment has invested 1 lakh in investment of 5 years. The year on year, the return is given as follows. Okay. For calculating the CAGR, we need to calculate the terminal wealth. That is the end of the period, value of the investment. As can be seen, 1 lakh has grown to 1,33,961 in 5 years. Using the formula for compounding interest, CAGR can be calculated as per the formula. As demonstrated below, CAGR is the constant rate of growth to reach the same terminal value. Annualizing return. For facilitating comparison, rate of return is reported as annualized basis. Annualized return represent the compound average annual return of the investment. The calculation is same as the calculation of CAGR of geometric mean return. Return are annualized by following this same chain link method, and the product of the linking is raised to the reciprocal of the number of years in the evaluation period. The first step is analyzing the return is to calculate the wealth relative. Next step is to take the product of the wealth relative. It is cumulative wealth relative. Next, raised to the reciprocal, the reciprocal of the number of years. If the measurement year is less than 1 year, it is advisable to calculate the annualized return as it means extrapolating the return to full year, particularly for those investments where the returns can fluctuate significantly during the remaining period. Cash drag adjusted return. Portfolio manager may not invest the entire capital contribution made by the investor. Variety of sector, variety of reasons. However, while computing returns for the investment period, the capital contribution made by the investor need to be taken into consideration. It has been observed that portfolio manager, we are not talking about account the cash component in computing. His practice misstates the return. Here, the customer has put the complete money and he is referring that complete money invested. And the manager or the performer is presenting it as the exact portion which was invested in equity against the equity. So this is wrong practice. Basically, this is not giving any clear picture about the investment. Most investment portfolio tangle alpha and beta decisions together. Alpha and beta. The return from such portfolios can be decomposed into alpha and beta returns by using the asset pricing model. The most popular asset pricing model is Capital Asset Pricing Model, CAPM, Capital Asset Pricing Model. The CAPM theorizes the risk consists of a systematic component that is non-diversifiable and a systematic idiosyncratic or unique component that is diversifiable. Risk that is unsystematic can be diversified away, hence, the investor should not expect compensation for. Hence, the investor should not expect compensation for bearing this type of risk. As per this model, investments are to be priced for their market risk, that is non-diversifiable risk. Market risk is as discussed in 10.3.3, it measured by beta. Under CAPM, the required return on security or portfolio compute as required return is equal to free risk-free return plus beta into market return minus risk-free return. Alpha is the return generated by the portfolio over the required rate of return as per CAPM. Alpha is the return generated by portfolio the over the required rate of return as per CAPM. The understanding decomposition of return, look at following example. Portfolio has generated a return of 25%. Market benchmark return for the same is 15%. The beta of the portfolio is 1.5. Treasury bond yield is 5%. Alpha return is the reward for bearing non-market risk. Beta return is rewarded as being market risk. Alpha return is rewarded for bearing a non-market risk. Beta return is reward for bearing a market risk. Some professional make distinction between the alpha and Genesef alpha. They refer to the excess return over the market benchmark return as alpha. In the above example, excess return is equal to 25 minus 15, that is 10%. They refer to the excess return over the market benchmark return as alpha. Here it is very simple. You can see the return and weightage in the portfolio, those should be multiplied. Now the risk measure. We are dividing this chapter into sections. The risk measures will be covered. We will be covering in the next video. Now let us stop over here. We have understood the half portion of this chapter. This chapter is very important because major contribution from this chapter towards marks is very high.